Defaulting to a standard commercial real estate asset passively depreciates the property over 39 years, whereas executing a cost segregation study mathematically accelerates decades of tax deductions into a massive year one liquidity event. When a high net worth investor or enterprise founder acquires commercial real estate, the IRS assumes the physical building degrades evenly over a 39-year timeline. This standard straight line depreciation trickles out a predictable but negligible annual tax benefit. However, the federal tax code allows for a structural engineering audit, a cost segregation study, to completely reclassify the internal architecture of the asset. By legally bifurcating non structural components, like specialized electrical systems, dedicated HVAC, plumbing, and aesthetic fixtures, these assets are reassigned to highly accelerated 5, 7, or 15-year depreciation schedules. When paired with current bonus depreciation frameworks, this allows investors to front load massive paper losses to actively offset operational cash flow. The mathematical impact. Consider the acquisition of a $5 million commercial facility by an enterprise founder in the top 37% federal tax bracket. Standard framework, straight line depreciation, yields a rigid deduction of approximately $128,000 annually. This translates to roughly $47,360 in actual cash tax savings for year one. Cost segregation framework. An engineering audit reclassifies 20% of the property's basis, $1 million, into short-term assets. Utilizing accelerated and bonus depreciation rules, the year one deduction mathematically spikes to roughly $600,000. The result: this engineered deduction translates to $222,000 in immediate cash-in-hand tax savings. Without taking on any additional market risk, the investor extracts an additional $174,640 of entirely tax-free liquidity from the exact same real estate transaction in the very first year. This trapped equity is converted into liquid capital that can be immediately reinvested, permanently increasing the compounding velocity of the private balance sheet. True wealth architecture requires treating commercial real estate not merely as a yielding physical asset, but as an active, highly engineered structural tax shield. To mathematically evaluate the tax efficiency of a pending commercial acquisition or audit an existing property, contact Lone Wolf Wealth Management to initiate a real estate capital review. Regulatory disclosures. Lone Wolf Wealth Management is a registered investment advisor. This content is for educational and informational purposes only and does not constitute personalized investment, legal, or tax advice. Firm CRD 340537.